Right now, your money is under attack. Oil just had its biggest weekly surge in 40 years. The stock market had its worst week since April. And most people have no idea what to do. I'm going to cut through the noise. In the next 9 minutes, I will tell you exactly what is happening, what it means for your money, and the 5 specific steps you need to take right now. This is Wealth Realist. On February 28, 2026, the United States and Israel launched coordinated strikes on Iranian military infrastructure. They called it Operation Epic Fury. Iran retaliated within 24 hours. Missiles hit U.S. bases in Qatar, the UAE, and Bahrain. Within 48 hours, the Strait of Hormuz was effectively closed to oil tanker traffic. Now here is why that matters for your wallet. 20% of the world's entire daily oil supply passes through the Strait of Hormuz. That is 17 million barrels every single day. When that route closes, oil prices spike. They went from $65 a barrel to nearly $90, a 36% jump in a single week. Goldman Sachs called it the biggest single-week oil surge since crude futures began trading in 1983. The financial markets reacted immediately. The S&P 500 fell 2.1%. The Dow Jones lost 1,247 points. European markets fell even harder, down 5.5%. Japan's Nikkei dropped 5.5% overnight. But, and this is critical, not everything went down. Energy stocks surged. Gold jumped 3.2%. The energy ETF XLE rose 4.8%. There is always a crisis, and there is always an opportunity inside it. Now let's talk about what this actually means for your money, starting with inflation. Before this war, CPI was at 2.4%, very close to the Fed's 2% target. When oil prices jump 36%, that feeds directly into everything you buy. Fuel, food, transport, manufacturing. Goldman Sachs and JP Morgan both warned CPI could push above 4% this year. In simple terms, your money will buy less than it did last month. Impact number 2, your investment portfolio. Your 401k, your IRA, your brokerage account, they all took a hit this week. Growth stocks were hit hardest. Tech, consumer discretionary, clean energy, all down. Now I need you to hear this clearly. Do not make any decisions based on fear. I will show you, in a moment, exactly what history says about moments like this. And the data will surprise you. Impact 3, your everyday energy costs. Gasoline is now at $3.41 per gallon. Heating costs are rising. Electricity bills will follow within 60 to 90 days. If you drive regularly or heat a home, budget an extra $50 to $100 per month for the next quarter. This is practical. This is manageable. Adjust now, before you feel the squeeze. Impact 4, and this one is actually good news. For prepared investors, energy stocks and defense stocks are rising sharply. ExxonMobil up 3%. Chevron up 4%. Lockheed Martin up 2.8%. The energy ETF, XLE, up nearly 5% this week alone. Impact 5, Federal Reserve rate cuts are now delayed. JP Morgan called it a, quote, tricky stagflationary mix. Translation: higher inflation plus slower growth means the Fed cannot cut rates as planned. If you have a variable rate mortgage, this matters directly for your monthly payment. Now, the 5 actions you need to take. Action 1. Do not panic sell. I know the screen is red. I know the headlines are terrifying, but here is what the data actually shows. In every single major geopolitical crisis in history, the investors who held their positions dramatically outperformed the investors who sold. Gulf War, 1990. Markets fell sharply. 6 months later, the S&P was up double digits. The people who sold in the panic missed the entire recovery. Oxford Economics believes this conflict will not last beyond 8 weeks. If they are right, every dip is a buying opportunity. Build or top up your emergency fund. The goal, 3 to 6 months of living expenses. Sitting in a high-yield savings account. Not under your mattress, not in your checking account. In a high-yield savings account, where it earns 4 to 5% annually, while staying fully accessible. My 2 recommendations: Marcus by Goldman Sachs or Ally Bank. Both are FDIC insured. Both pay competitive rates. Having this fund means you will never be forced to sell your investments out of desperation. That one fact alone will make you a better investor. Consider a tactical position in the energy ETF, XLE. This is the Energy Select Sector SPDR Fund. It holds ExxonMobil, Chevron, ConocoPhillips, and other major energy companies all in one fund. When oil rises, this ETF rises with it. I want to be clear, this is a short-term, tactical play. When the conflict resolves, and it will, oil prices will fall back. So this is not a long-term holding. Consider 5 to 10% of your portfolio, maximum, and have a plan to exit when the situation de-escalates. Add a gold hedge to your portfolio, using the ETF ticker GLD. Speeder Gold Shares is the most liquid gold ETF in the world. It tracks the price of physical gold directly. Gold has been a crisis protection asset for 3,000 years. It is up 3.2% just this week. My recommendation, 5 to 10% of your total portfolio, not more. Gold does not pay dividends. It does not grow like a business. But in a crisis, it protects purchasing power, while everything else is falling. You can buy Geld on Fidelity, Vanguard, or Schwab today. Action 5, and this is the one most people miss: buy inflation-protected bonds, using the ETF ticker VTIP. This is the Vanguard Short-Term Inflation-Protected Securities ETF. Here is how it works. The principal value of these bonds automatically increases when inflation rises. So if inflation hits 4 or 5%, your VTIP position grows to match it. This is the step that protects your purchasing power in the scenario where the conflict drags on. 5 to 10% allocation. Available on every major brokerage platform. Now, Goldman Sachs laid out 2 possible futures. Let me walk you through both. Scenario A, short conflict, under 4 weeks. Goldman calls this their base case, the most likely outcome. The Strait of Hormuz reopens. Oil falls back toward $65 per barrel. Stocks fully recover within 3 to 6 months. The Fed resumes rate cuts in the second quarter. If Scenario A plays out, this week was a buying opportunity. The investors who held or bought the dip will look very smart by summer. Scenario B, prolonged conflict, over 4 weeks. Goldman calls this the tail risk. Less likely, but you need to be prepared for it. In this scenario, oil pushes toward $100 per barrel. Inflation reaccelerates sharply. CPI could hit 5% or higher. Stock markets remain under pressure through Q2. Growth stocks are hit hardest. In Scenario B, the actions I just described become even more important. Your gold position protects you. Your VTIP position protects your purchasing power. Your emergency fund keeps you from making desperate decisions. Before I summarize, let me leave you with one thought. In 1973, oil quadrupled. Markets fell 50%. The investors who stayed calm and stayed invested built enormous wealth through the 1980s. In 1990, Iraq invaded Kuwait. Oil doubled overnight. 6 months later, the S&P 500 was up double digits. In 2022, Russia invaded Ukraine. Global energy crisis. 40-year inflation highs. 18 months later, the S&P 500 hit brand new all-time highs. Every single crisis in history has eventually ended. Here are your 5 steps one more time. 1. Do not panic sell. 2. Build your emergency fund. 3. Consider the energy ETF, XLE. 4. Add gold via GLD. 5. Buy inflation protection via VTIP. If you found this useful, please subscribe. New videos every Monday, Wednesday, and Friday. And I have a free guide waiting for you at everydaycalculators.com/free guide. Stay calm, stay informed.